Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifel. And it feels like we're in a little bit of a quiet period right now after, of course, a hefty week last week.
Jay Powell has spoken. The Fed meeting is over, but earnings are not.
A lot to look forward to. So let's get to the biggest stories right now in the more than $12 trillion global ETF industry. And as investors push up the timing of a Fed rate cut, we'll be speaking to BlackRock's Kristy Akullian about where she sees opportunities.
Also with us, Chen of DoubleLine, who says the most, quote, draconian scenarios have been priced out of commercial real estate.
And a big move in the industry of Brian Lake departing JP Morgan for Goldman Sachs. We're going to get to all of that in just a few moments. But as always, Eric Balchunas from Bloomberg Intelligence here with us now, looking at the flows. Eric, what do you got?
Katie, Scarlett, thank you. So the flows are showing a little bit of a continuation of last week, which was that there's a little bit more love for fixed income. This whole year, up until 2 weeks ago, it was basically equities and Bitcoin, right? There is people moving into fixed income. Maybe it's those higher yields. Maybe it's because equities feel a little exhausted. We'll talk about that in a minute. But look at the 1 week inflows. There is some good news, IVV and the Qs and VU. That's obviously bullish equities there. But look at MUB. MUB is rarely up there. That's a muni bond ETF. Then you got TLT. That hasn't made an appearance in a while. Down the list, 10 of the top 20 are now fixed income. A couple weeks ago, it was like 1. Okay, let's look at the outflows now, and you can see where there is some trading crowd moving out. SPY seeing outflows. 2 energy ETFs in the top 10, XLE and XOP. IYR seeing outflows, and you go down there, again, it's mostly equities. So let's take this moment to actually look at the big board, which is our dashboard and all the asset classes. And I just want to show you this shift in from April to May, or really from the whole year till May. It's perhaps a bit of sell in May. You have equities taking in 36 billion, 73 billion, 14 billion, and then boom, -3. So they've been trending down kind of and now negative. And then you go down here to fixed income, which is this one, and it's plus 7 billion. But look at what fixed income normally does, 15, 13. So we're already halfway to what they normally do in a couple days. That's a big shift. And the money is going in all over the board. It's not just the treasury play. It's not just short end of the curve. Oh, that's where a lot of the money's going. It's corporate and government sort of each pulling its weight here. So Katie, Scarlett, fixed income finally getting some love after really, it's been ignored all year.
And like you said, it's really a blanket buy, too. It's not any one specific asset class within fixed income. Let's keep the conversation going now with Kristy Akullian. She is head of iShares investment strategy for the Americas over at BlackRock. And it's interesting when you think about what we're seeing so far in May, and I'll note that it's extremely early, but money coming out of equities, going into bonds. How much of that is seasonals versus maybe something new that we learned when it came to the Fed or when it came to, of course, the corporate environment?
Great question. Thanks for having me, Katie. Excited to be here. I think that the market is digesting a lot right now. And as you mentioned at the top, obviously we're going through and close to the end of earnings season here. So I think it's fair that markets are pausing a little bit and just really reflecting and digesting on all of the information that we've gotten. I don't necessarily think that it's going to be a challenge environment for stocks going forward for the rest of the year, even though we may see a little bit of choppiness right now seasonally. One of the things that we're talking about and writing about is just that even though, we saw the Fed last week, obviously still on pause, very much as expected, we don't necessarily think that equities need to see rate cuts to be able to continue to move higher. But that is really specifically true of kind of the higher quality segments of the market. So we're still really talking about and hearing clients really allocating to things like qual. QUAL is our quality ticker there. And I think that's something that can continue to do well, even though we kind of are wading through a bit of uncertainty, to your point, on the technical side, but also certainly on the macro as well.
So I'm glad that you mentioned quality, because your macro view features this idea that rates will stay restrictive longer, higher for longer, in other words. And therefore, that leads to your focusing on the quality factor. We've seen this big rally in equities, and I know you talked about QUAL as an ETF to focus on, but which asset classes offer the best value when it comes to the quality factor? You've got pretty tight spreads in credit, for instance.
Yeah, no, it's a great question. And I think we like to be up in quality pretty much across the board, across asset classes right now. Again, given that we think we're in this slightly more challenging macro environment. But one thing that I'll say here, too, is that not only are we thinking about how to allocate across asset classes, but we're thinking about the strategies as well. And one thing that we've really found this year to be true, and I think this is a continuation of last year, is that investors are really willing to embrace active strategies, and they're really looking to do so in the ETF wrapper. I think there's a lot of reasons why we're seeing that to be the case. But within fixed income, for example, I think that there's a lot of opportunity in really high yields, but there's also a lot of risk in the fact that credit spreads are as tight as they are. And so something like BINC, B-I-N-C, has really been a focus ticker for us and for many investors, and popular with some of the model platforms as well, just as a way to sort of capitalize on the opportunity set, but also adding a layer of active management to sort of prevent against rapid changes in economic conditions, and really just be able to be nimble in this environment.
Speaking of quality and active, your model, the BlackRock model, which everyone loves to follow, rotated into DYNF, which nobody really had heard of until a bomb of money went into it earlier this year. For people who are just intrigued by your model, what does this ETF do? What are you really getting with this ticker?
Yeah, so this is one of the most common questions we get right now, as you can imagine. Went from close to zero AUM to above $7 billion. It's now the largest active ETF that BlackRock offers. And to your point, almost overnight. So what this is it's a dynamic factor rotation model. And what it holds right now, I can tell you what it looks like, is a lot of really high quality. So this is an active fund that is able to go into different parts of the market, and it seeks out different factors over different periods. Right now, like I said, it's high in quality, it's underweight small caps as a result. It's relatively long momentum. But the really important thing about this being active is that in a year where we expect a lot of inflection points in sort of the macro backdrop that we're living in, I think investors are really looking for a strategy that can move along with markets. This is a fund that's managed by our systematic team, our quant team internally. And so they're looking at not only traditional data sets, but also alternative ones as well. So I think that the idea being that this can kind of capture those trends and those changes in the macro backdrop faster than investors can. And I've had some conversations, obviously with our model portfolio team here. One of the things that really drew the PM to that fund is that idea that he doesn't necessarily need to trade intra-quarter for the fund and for the model to be able to reflect current market conditions. So I think that not only is the appeal just in the dynamism of the product, but also in the tax efficiency, again, going back to the idea that it's that ETF wrapper too.
Can we talk a little bit about what a quality company is in this market? Because people describe, the attributes of a quality company, and to me, it just sounds like big tech. So how is BlackRock thinking about what actually makes up a quality company right now?
Yeah, and I think that's a common misconception or common question there too. If you ask people to define, 5 people to define quality, you'll get 5 different answers. Typically, we're looking at 3 different metrics, and I think it's the combination of all 3 that gives us a fairly high degree of confidence that we're getting a quality allocation. So we look at profitability as being one of the most important drivers of future returns. We look at the consistency of earnings over time. So we want a company that can't just deliver in the current part of the business cycle, but in all parts of it. And then we look for volatility as well. So we're really looking across all of these different metrics. And I think it's that holistic picture that gives us that quality attribute. And specifically when we're looking at something like qual too, I would say that is a sector neutral fund.
Yeah.
So it may be overweight technology or some of the more traditional sectors that are considered when you think about quality, but it is going to mirror what the broader market looks like. It isn't entirely skewed one way or the other. So it's choosing the highest quality companies within each sector, as opposed to just choosing the highest quality sector.
So, Kristy, student protests across U.S. college campuses are calling for endowments to divest from companies with ties to Israel. That's a complicated request, given that endowments invest in all kinds of things, from private equity to hard physical assets like real estate, as well as things like ETFs and index funds. What can you tell us about how exposed endowments are to things like ETFs, like index funds, where it'd be difficult to unwind specific investments?
Yeah, it's a great question, and I'm not sure I can comment specific to the endowment holdings or to this situation in the Middle East or the protest around it. What I would say, though, is that it's a very helpful tool to have ETFs in your portfolio because they're transparent. So you can look and see exactly what your exposure is and make the decision that's right for you and the investors that you serve.
All right, Kristy, really appreciate your time today. Great to have you on ETF IQ. Hope to do it again soon. Our big thanks, of course, to BlackRock's Kristy Akullian. Now coming up, a lake-sized hole at JP Morgan. We'll discuss Brian Lake's move to Goldman Sachs next. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF Brief, where I walk you through the trends and the stories that caught my eye in the ETF world. And we start with big tech. You're taking a look at semi-annual inflows into technology ETFs. And as you can see, so far in 2024, those funds have taken in close to $10 billion. You take a look at semi-annual periods going back to 2005. That is a record. So, of course, we'll see if that momentum can continue. But for right now, investors love tech, and they also love bond mutual funds. We're going to, of course, talk about mutual funds right now on the ETF show, because bond mutual funds are doing something rare, and that is pulling in new money. As you can see, fixed income mutual funds have taken in over $100 billion so far this year. That follows 2 straight years of outflows. So clearly, investors liking big tech, and they also like bonds. So there you go. Let's talk, though, about the hottest story in the ETF industry over the past week. And that, of course, is Goldman Sachs poaching Brian Lake from JP Morgan. Brian Lake, rather, was the global head of ETF solutions over at JP Morgan. He'll be joining Goldman as a partner. He threw up an asset board there. And as you can see, JP Morgan has really pulled away from Goldman Sachs, closing in on $150 billion in assets under management in their U.S. ETF business. Goldman, meanwhile, hanging out at around $36 billion, Scarlett.
All right, so let's talk about more on this issue with our very own Eric Balchunas. Eric, clearly you see how JP Morgan pulling away from Goldman Sachs, but talk to us first about Brian Lake and what his legacy is at JP Morgan.
Yeah, look, he was brought in, to JP Morgan. They were, I think, 20th place in ETF assets. Now they're 7th. It is rare to go that high that fast, and he's an ETF guy. He really got his, he was brought up in Invesco and PowerShares before that. So he comes over. I give JP Morgan a lot of credit. They seem to give him a lot of freedom to build an ETF business. Not every asset manager is that lenient. But he really did a good job of doing both beta, passive, cheap beta, and active. And therefore, the people who are working at JP Morgan or other advisors have tools in their toolbox to use. And the active that he created, JEPI is probably the best example. They have the biggest active equity and the biggest active bond at JPST. #1 in both, hard to do, but they're both moderately priced, right? They're at a point where an advisor can go, you know, it's JP Morgan, got a cover call strategy, doing a lot of legwork, 35 beta, it's fair, right? This is different than the stock picker person who underperforms charging 1%. This is, JEPI to me is like the new playbook on active. Do a little legwork, beta adjust your fees, and you're gonna sell some stuff. So he really, I think, paved the way and wrote the playbook for how to sell active in the Vanguardian future.
Yeah, now, of course, JP Morgan is just a powerhouse in active ETFs, as Eric walked us through. But talk to us about the Goldman side of things, because it hasn't exactly been the same experience. And, of course, Brian Lake, he's joining as partner, so he will have a wider aperture than just ETFs. But what could this mean for Goldman?
Yeah, they were one of my 3 guesses of where he was going, by the way. MFS was the other, because they just filed, they need somebody. And Invesco, I thought he might return home. But Goldman was a guess because they need help. They were really on the same page as JP Morgan for a couple years, about 8, 9 years ago. They came out with GSLC, which I thought was, again, a new version of active. 9 basis points for a multi-factor ETF, and the Goldman brand name, advisors were eating it up. And then something happened. They just plateaued. It's like they took their foot off the gas about 5 years ago. Now this year, for example, they're seeing outflows, and GSLC is seeing outflows. How can an equity ETF priced so cheaply with the Goldman name see outflows? The fish are jumping in the boat this year. Something's up over there, right? So I think Goldman, either they're looking for expanding other things besides ETFs, maybe, and this is something he could do on the side. I don't know exactly what his purview will be, but I can't imagine he's not going to be tempted to reboot that ETF business. But they've got good products. All they need is the passion and the marketing back to get the assets back in.
All right, so let's focus on the ETF side of the business that Brian Lake might reignite over at Goldman Sachs. Could he replicate his playbook from JP Morgan at Goldman Sachs? Well,
Goldman already did that. Goldman has a JEPI knockoff, which is a total compliment, right? So they've already got Brian Lake type ETFs over there. So all they need is passion and marketing and somebody in upper management to go do your thing. Sometimes at these shops, someone in upper management just like, wait a second, these ETFs cannibalize the mutual fund business, and they shut them down or they suppress them. So those are the things that need to happen for Goldman to rebuild its business. They have the products.
They have the products. All right, Eric Balchunas is, of course, our go-to expert on all things ETF, talking about Brian Lake leaving JP Morgan for Goldman Sachs. Still ahead on ETF IQ, we drill down into commercial real estate with Morris Chen of DoubleLine. This is Bloomberg. This is Bloomberg ETF IQ. I'm Scarlett Fu, along with Katie Greifeld.
And Eric Balchunas is here with today's drill down, where we focus on one ETF. Eric, hit it.
Katie, we're looking at DCRE today, which is the DoubleLine Commercial Real Estate ETF. The name is the description. Commercial mortgage-backed securities are what this holds, and it's active. That's the big thing you need to know. You can see here, actively managed equals yes. This is using DoubleLine's bond picking skills. Came out 1 year ago only, 39 basis points. I think that's a pretty fair deal for active on the cheaper side. Market cap is 131 million. That's pretty good for an ETF that's a year old that is in more of a niche area like this. So let's look at what it holds. If you follow CMBS, you are going to recognize these names. If you don't, you probably won't. But the point is, these are going to obviously change, and these are hand-picked by DoubleLine. This is not an index it's tracking. So with that, let's look at this ETF versus the CMBS index ETF, which is the one from iShares. We'll call that beta. And I also threw the ag in there just because a lot of people own that, and it's a good benchmark for bonds in general. And you can see here, DCRE is blowing them away. It's probably why it has 100 million already. And you can see a lot of its return come from a big yield here, 6.5%. And you can see the white chart here. And look, it's really doing it with less volatility. I mean, this is really all you can ask out of an active manager. Low fee, low vol, benchmark beating returns. So Katie, not surprised this thing's off to a fast start asset-wise.
All right, Eric, thank you so much. And joining us now is Morris Chen, of course, of DoubleLine. He manages this ETF. And Morris, so you launched this ETF March 31st, 2023, really in the eye of the storm following Silicon Valley Bank. Not everyone is that brave. So contrast and compare, of course, what commercial real estate, that market that you're actively picking in, what it feels like right now versus when you launched this thing.
Yeah, thanks, Katie. I think it's a market difference. And the biggest thing is there was a lot of fear-based selling and general avoidance of the commercial mortgage-backed security sector. I think overall, even commercial real estate, and that's not to blame anyone, but that was the dynamic, especially with what's going on in regional banks when we first started. Now, fast forward to currently this year, what's interesting is the CMBS market is wide open. There are loans that are being made. The issuance volume has increased in a meaningful manner, and investors, more importantly, are back. Investors are looking at bonds, trying to assess relative value versus other credit sectors, and placing their assessments, at least in terms of money, where their mouth is in terms of what they're seeing in the CMBS market. So I think for us, we're clawing back to normalization. I think that's what's interesting is that investors are back.
Right, clawing back to normalization. I like the way you put that. At the time, there were a lot of warnings that there was another shoe to drop when it came to commercial real estate. Yet that has not happened, even with rates staying higher for longer. What is the single most important reason why? Is there another shoe out there?
I think if you want to describe what's going on, we all observe commercial real estate based on what we see visually as well as what we read, and clearly there's the office headlines that day in and day out continue to hit the news tape, and or even just from an experiential standpoint, when you go into your own office, you'll see what that is. But as I kind of talked about in the past, real estate is really property market centric, property specific as well. that shoe to drop sort of comment in itself, to me, it's a it's not as simple as answering yes there is and or no there isn't. I think it's really dependent on what we're talking about. At least in terms of commercial real estate, I can tell you hotels are doing well. I can tell you some apartment markets are also doing well. And so it's to me it's less of a shoe to drop sort of comment. It's about where is it and what's going on, and that's really how we look at the lens.
And let's talk a little bit about money market funds in the short end of the curve. Cash is yielding 5.5%. That is really appetizing with zero risk. I'd imagine you're out there trying to talk about this, and that's one of your biggest competitors, is just putting it in the sort of T-bill and chill ETF or money market fund. How do you sell against that? I know you yield a little more, but it's not a ton more.
Yeah, look, I mean, I think, from our standpoint, our yield to maturity on the fund is 6.5%. And as we kind of, look at the fixed income metrics in terms of our portfolio, we do have a discount dollar price portfolio around 99 cents on the dollar. That 1 point discount in itself is, what investors are trying to hire us for, and us to harvest that within a timely manner. So as you're kind of thinking about the relative value comparison versus, say, something like T-bills, for us, from a fund level perspective in itself, I can tell you that we have a duration of 1 with a average life of 1.8. You get this yield for a longer time frame, and then I think also more importantly, we're here to actively manage. We're here to try to add excess return. And by picking and choosing securities day in and day out within our portfolios throughout the market environment, we're confident that we'll continue to beat either its risk-free
Right.
or whichever benchmark we're benchmarked to.
And I only have about 45 seconds left with you, but I am curious because you mentioned that within commercial real estate, it's not all office. There's sections that's doing well, such as hotels. I actually just had a fascinating conversation with someone who made the point that data centers really hot right now. I'm curious if you're looking into that over at DoubleLine.
Yeah, it's a sector that's still fairly new within the commercial mortgage-backed arena. From an issuance standpoint, it continues to ramp up. We definitely have our eyes on that particular sector, but it's not a large cohort of the CMBS market. I do think with what's going on in the tech space as well as AI, we'll likely see issuance in the data center space continue to grow as well. So that's something that, again, I look at it as a menu of items. I can invest in bonds backed by data centers or retail shopping centers and the likes.
All right, Morris, great to speak with you. Our thanks to Morris Chen of DoubleLine. That does it for Bloomberg ETF IQ. I'm Katie Greifeld with Scarlett Fu and Eric Alchunas, and this is Bloomberg.